Every dollar you pay in unnecessary tax is a dollar you cannot reinvest in your business or your life. But what if you could slash your taxable income by up to 20% with a single deduction many owners miss? The tax code also permits turning family expenses into business deductions, legally. We will show you how. These are not loopholes, they are intentional strategies. Major savings come from deliberate planning. In the next 5 minutes, we'll build your savings plan around 4 pillars: structure, deductions, people, and timing. Pillar 1 starts before any strategy. Clean, accurate bookkeeping. Without it, you cannot prove your deductions, and you are flying blind. With your books in order, the single most important decision you'll make is your business structure. Are you set up to minimize taxes from the start? Most small businesses are pass-through entities, meaning profits pass to the owner and are taxed on their personal return, avoiding double taxation. This pass-through status is what gives you that powerful 20% qualified business income deduction we mentioned. It is a direct reduction of your taxable income. Beyond structure, Pillar 2 is about maximizing every available deduction. This is where you actively lower your taxable income, item by item. This includes the obvious, like interest on business loans and credit cards. It also covers business travel expenses with a legitimate business purpose. But one structure, the S-Corp, has a unique advantage. How can it legally slash one of the most painful taxes, the 15.3% self-employment tax? The answer is in how you pay yourself. As an S-Corp owner, you must pay yourself a reasonable salary, which is subject to the full self-employment tax. But here is the magic. Any profit left after that salary and other expenses can be taken as a distribution. These are not subject to self-employment tax. So if your business profits $150K and your reasonable salary is $70K, you only pay self-employment tax on that $70K, saving you over $12,000. Getting your structure right is the highest impact decision you can make. Now, let's move to Pillar 3, using people and benefits to your advantage. First, supercharge your retirement. Contributions to plans like a SEP IRA or solo 401k are direct deductions from your business income. Second, use an HSA. Your contributions are pre-tax, the money grows tax-free, and withdrawals for medical expenses are tax-free. It's a triple benefit. Third, hire your children. Pay them a reasonable wage for actual work. Their wages are a business deduction for you, keeping more money in the family. If your business is a sole proprietorship, wages paid to a child under 18 are often exempt from Social Security and Medicare taxes, a direct, significant saving. These personnel strategies turn expenses into deductions. Our final pillar is where true strategy comes in: advanced planning through timing and credits. First, understand this. A deduction reduces your taxable income. A credit reduces your final tax bill, dollar for dollar. Credits are far more powerful. Look for the Work Opportunity Tax Credit, giving you up to $2,400 for hiring individuals from targeted groups, or the Healthcare Tax Credit for employees. Timing is your other strategic weapon. Need new equipment? Buying it before December 31st allows you to deduct the expense in the current tax year. The tax code supercharges this with Section 179, letting you deduct the full cost of equipment immediately. Bonus depreciation is another tool for this. The flip side of accelerating expenses is deferring income. If you can wait to invoice a client until January, you push that taxable income into the next year. We have covered the 4 pillars: structure, deductions, people, and timing. But how do they work together to create an unbeatable strategy? Let's connect the dots. The home office deduction is a solid strategy, but your business structure can affect how you claim it and how valuable it becomes. Recall the S-Corp strategy. The salary you pay yourself determines contribution limits for retirement plans. you can optimize both for maximum effect. Think about year-end. You can combine accelerating expenses with deferring income. This two-pronged timing strategy creates a massive swing in your taxable income. The real takeaway is that these pillars are not separate. They form an interconnected system. Your structure affects deductions, which are influenced by timing. So remember the 4 pillars. Optimize your structure, maximize every deduction, use strategies with your people, and master your timing. As we have shown, significant tax reduction is not about finding one secret trick. It is about building a year-round strategy using these proven pillars. This is about gaining control, fueling growth, and building a more resilient and profitable business for your future. Do not leave this money on the table. Take one strategy from this video and discuss it with your tax professional this week. Start planning for next year today.